Hello and welcome to FX Street Currency in Play. I'm Matt Brown, coming to you from the heart of London. I'm joined today by Ed Matts, actually in the studio of MatrixTrade.com. How are you today, Ed?
I'm very good, Matt, and thanks for inviting me.
Absolute pleasure. Well, sorry about the weather in London today, but can't help that, I'm afraid. Right, let's have a look at the headlines, the trends, what's moving the market. Starting off with euro dollar in recovery mode after dropping to 1.1720 on Tuesday. Bit of a sell-off for the euro yesterday. What drove that? Dollar strength?
Well, JOLTS reports, labour tightening came as a bit of a, people were expecting a bit of a quiet one. Obviously the Fed's between two minds, balance sheet reduction, higher interest rates, but numbers are soft apart from these labour tightening numbers or intimations that are coming out, and that's what happened. JOLTS came out showing even further tightening, dollar rallies, and what's the euro done? It's gone back to the previous high, classic retracement. Is it now a major bull market? No, it's going to go sideways, but this is very bottomish. I wouldn't get too involved here, or in fact I'd be a buyer down here, just on the short-term pump.
Understood. Cable as well, talking about bid on M&A talk. This is tight with Vanti buying WorldPay. I don't think that has actually moved the cable that much, but 130 a key level now.
No, it's been below, down 129. 129. It's been down 129.60, 129.30 is the previous interim low. The obvious thing is New York doesn't have a trade cable. They never have done for going back donkey's years. The points are too big for them, quite frankly. But what happens, they'll come in and sell it off and it should find a bottom and start recovering. It's got nothing to do with M&A talk. There's no real flows going through on mergers and acquisitions on cable. It's been a dollar play, and obviously also Brexit, but also because the market was getting overly long and wrong, above 132, etc. So that's, I think it's a short-term punt on the upside, looking 129.30 back to 130.5. And we talked last week about this process of 2 steps higher, 1 step back. It could well go to new highs again. And so now this level actually represents a good, relatively good value in that scheme.
Good stuff. Dollar yen as well, all about North Korea, sunk to 109.80, risk-off sentiment.
Yeah, and also, funnily, you got NK. I actually thought you meant the Nikkei, because the Nikkei broke. It's been in this long, incredibly tightening, boring triangle, and it broke to the downside. So everyone's gone, yeah, yours. And dollar yen, because they're link stepped, has come off, or more so than anything else. Yen crosses have strengthened. The yen has strengthened overnight on the back partly of that. It's a risk-off play, and we saw the stock market go up quite sharply and then come off quite sharply. Again, everyone's getting overly excited, claws its way back up. I think we'll have another one of these risk-off sell-offs, risk aversion sell-offs, which may put it under further pressure before it goes back up again.
Understood.
Don't get carried away. Yeah.
And the dollar index, well, we've already talked about the euro dollar, capping in 93.80 on solid data. We've already covered that, really. Yep. It's obviously the JOLTS report yesterday. So let's have a look at a few of your slides. Interest rate differentials. Talk us through.
Yeah, well, that's one thing at MatrixTrade.com we try to do. We try to identify what is driving a market, because, particularly in foreign exchange, it's a bit of a all things to all men, whether it's bonds, it's stocks, it's taper in the ECB, or what JOLTS reports, or what Janet Yellen going to do, Nikkei, etc. So it tends to get buffeted around left, right, and centre. But what's been driving the foreign exchange market for the last 3 months or so, and it's been the 10-year interest rate differential. And you can see from this chart alone how they've been, each currency pair, dollar pair, has been gripping its differential, with the exception of the euro. And what you saw in the last 2 weeks, you saw sentiment, people getting carried away on the break of that 117.10 level, getting carried away, and that's why it's come back up. They need to realign, and once it's realigned, it can do its own thing. Essentially, I think it'll go higher. But for the time being, that's sideways, which is one reason why I think we're entering a range market, which is a correction to a trend. But
yeah, so we see bar the euro dollar, everything moving in lockstep. So the sentiment gap for euro dollar, you see that closing.
Yes.
Do you feel the euro could sell off? Or
the one thing we found, we've done the studies going back years, is no move in foreign exchange can be sustained unless the interest rate differential goes with it, unless there's something untoward, like massive risk aversion in the currency, in which case you'll invert. It can't be sustained. So they have to come back together before it can go on doing its own thing. It's like walking around with a child, like the streets of London. I've got my family here. You can't go anywhere without your children.
Yes.
Yeah. Otherwise, you've got to go back, and that's what's happening in the euro, and that's what will happen in the next week or two before it can carry on.
Understood. Right, moving on. We have boom and bust, 1920s, 80s, 2010. It's almost the 10-year anniversary since the big crash, if you want to call it, or the sell-off, credit crunch. Let's have a look at this. I mean, they look very, very similar for the Dow.
Well, it's been fun. It's been a great, for us, it's been a great story. I talked about interest rate differentials, moving foreign exchange have been. What's going to move it for the rest of the year? That is the story, quite simply. And a lot of people, I'm sure, have been in here and said doom and gloom, stock market's going lower, and it's gone higher. In fact, we followed these are maps, essentially, for the last 4 or 5 years. And we've been bullish and we've been long every single day of this year. And we're still long because we don't think, although that chart's slightly out of date, we don't think we've seen the top yet. But when it happens, everything else is going to be a sideshow. And that means the dollar, you can put your differentials away. It's going to be a stock-led, flow-led move, and that will dominate the market. And as to what it will do, really depends on the cause. If you go to the next slide.
Let's move on.
This is a calendar match of the S&P prior to one of the previous crashes. That's a day-by-day map, and that has to be one of the most stunning historical matches I've ever seen. And it does say, it shows you've got scope for another blowout, so people getting overly excited at the moment, think it's going to fall, probably will go lower before it goes into that final blowout to the upside. And then you can see later, coming later in the year, we've got something special coming along, and that is going to dominate the dollar. And if you, let's move to the next chart, you can see dollar yen. If stock markets come off, there's two things that are going to happen. All the obvious currencies, the risk aversion plays will be not just long yen and short dollar yen, but also be long Swiss. Now that's going to be a mind-blowing turnaround if that actually happens. But it's also a question of working out what will cause the risk aversion, because that unfortunately is for, stocks coming off hard, bond market will get kicked into touch initially, and then obviously there will be signs of deflation and forget Trump growth, etc. The bond market will actually go back up on the back of that. But as to what the dollar does, really does depend on the cause. It's been strangely and perhaps excitingly been tracking the 1973 dollar decline, and now 1973. What's so special about that? Two things. One was Watergate, Nixon.
Yep.
And interestingly, he was implicated just at the tail end of the dollar decline. So you could argue, well, gosh, the dollar knows something no one else does, or some people don't. And then it went into an oil crisis, and the dollar went flying through the roof. So it's a hard one to gauge. We were confident about stocks. Dollar is more of a flex as to the cause. If it is just a general market sentiment move, what you'll see is the dollar will continue going down, and dollar yen, I think, is a fair reflection of that. And so will the Swiss will strengthen on the back of safe haven, unless someone nukes Switzerland or something stupid like that. Otherwise, you're looking at issues like balance sheet reduction. I don't think people have really fully accounted for the impact of balance sheet reduction. It's going to be the opposite of quantitative easing, and the dollar went down initially on quantitative easing, didn't sustain the drop when it went down. Balance sheet reduction will send the dollar higher. So what could be really ironic is you could see stocks crash, bonds will start flipping around and go higher and then lower, higher on balance sheet reduction, then come off on deflation. But the dollar will go much higher and then crash. So what it's saying is, whatever the cause, stocks down later in the year, massive volatility.
Yes.
And it's going to be, and anyone, a lot of people have been calling this scenario for a long time, and we haven't. That's why we're so excited about it now, because it's going to be quite a wrench to change our whole approach. But this weekend we've bring in a few of our hedge fund clients to talk about not just the obvious ways how you sell dollars, sell stocks or whatever, how you trade that, but some of the esoteric, cleverer ways of doing it, where you can maximize your gain by going for some of the big plays, but at the same time not banking, betting the whole house on the one trade. So there's some clever plays out there, and we're going to try and nail them and come out with some strategies.
And briefly, what could be the catalyst? I mean, you mentioned the unwind of the balance sheet, but that's not going to happen overnight. So could it be North Korea or oil price through the roof if we have trouble in the Middle East?
I mean, that's one thing I'm not, I may pretend to have a crystal ball, exactly, and a crystal ball about markets based on price action, based on history. One thing we do, someone says, well, this time is different. That may be the case, but the conditions are similar. The way people are reacting is similar, and it says there's something out there that could be similar that will trigger the same sequence of events. And to say it's going to be Donald Trump resigning, no, I've got no idea, but we know if that's the pattern, that's what happened. But is Donald Trump going to resign just before an oil crisis? No. I mean, it's just not going to happen. But the same sequence of events could happen. Balance sheet reduction is an obvious one because that's massive tightening.
Yes.
At a time when the US economy doesn't appear to be flying, things have started tailing off, be sucking out their liquidity. The banks will have less money to play around front-running auctions. They'll have less money. Swiss National Bank will always have money, but the commercial banks will have less money to pump the stock market. And so you could see a real turnaround on the back of that. So that's an obvious one, and that's likely to be September. It's not always when they actually do it, is people will front-run it, and so it's the anticipation. You saw it with quantitative easing. When it was announced and hinted and eventually it had a big impact, but eventually when it came through, the impact was actually less.
Better to travel than arrive sometimes on that story. Right, looking at your cartoon for the day.
For the day, for the week? Actually,
forward.
it's been for the year, because
Yes.
basically what we've been doing is riding the stock market, bull market, and the dollar as a consequence. And essentially saying that what we're doing now, the interest rate differentials, dollar Canada picks up, comes down, we're just rearranging deck chairs on the Titanic. The Titanic is coming, and then it's going to question of how you position for that. So at the moment, don't get carried away, because these are all little side stories. The big story is coming later, and volatility. I mean, it's been quite volatile already. I mean, it's a sign.
Over the summer
And if you look at stock rotations and some of the correlations breaking down, shows the market is I think you could describe it as broken, but effectively it's inherently unstable, which means it can really go all sorts of exciting places. So I think 2017 will go down in history as being one of the most exciting trading environments there's been in many a year.
Brilliant.
That's why I'm so excited.
Because there's money to be made if you're sensible. Right, economic calendar. Let's have a quick look at this. Obviously, the jolted the market yesterday, a bit of a surprise. But anything jumping out at you that we should look at here?
Yeah, there's obviously unit labour costs is going to be a bit of a given what happened yesterday, a potential fly in the ointment. Stocks, crude stocks, we're still bullish on oil. So we're looking for a trigger. If we can get a snap down, we can add to our long position. But basically, we think it's going for the highs, and that's going to really screw people. As to whether that's the forerunner of the oil crisis, who knows? But one thing about Canada, actually, the numbers is going to be interesting, is because for the last month, when dollar Canada has been coming off and Canadian dollar's been strengthening, people have front run and been pretty right in front running these numbers, because what happens is number comes out whatever, dollar Canada goes down. Now you've seen a 300 pip rally. It'd be interesting to see if sentiment has changed, and now, or maybe people got stopped out trying to push the upside. Personally, I think we're going to get another bout of Canadian dollar strength. Nothing special, back to the lows. So I'd like to see this as a potential trigger for what we've seen before. In other words, another go at the lows Canadian dollar strength. But it's going to be interesting just to see if it's going to be another straw that breaks the camel's back.
Yeah. Understood. Well, Ed Matt from matrixtrade.com, thank you very much for joining us today.
My pleasure.
Absolute pleasure.